Bruce Greenwald's book Value Investing, From Graham to Buffett and Beyond is one of the most important works on value investing. Greenwald, a professor at Columbia University and one of the most prominent experts in the field of investing, has brought profound principles on how to evaluate and invest in companies with real value. This book is not only a theoretical guide but also provides practical strategies for those who want to pursue value investing. Here are the important lessons learned from the book. 1. Invest in value instead of stock price. Bruce Greenwald emphasizes that value investors need to focus on the real value of a company instead of just looking at the current stock price. Intrinsic value. Greenwald explains that stock prices do not always reflect the true value of a company. Value investing requires you to properly assess the intrinsic value of a company based on factors such as cash flow, profits, and sustainable growth. Careful valuation. Determining the true value of a company is not easy, but it is an important factor in ensuring that you do not overpay for a stock and can earn long-term profits. 2. Sustainable competitive advantage. One of the core elements of Greenwald's investment strategy is to look for companies with sustainable competitive advantages. Competitive advantage helps a company maintain market share and profits over the long term. Companies with competitive advantages such as strong brands, market exclusivity, or low production costs will be able to overcome competitors and grow steadily. Sustainable business model. Greenwald encourages investors to look for companies with simple but effective business models that help the company maintain and strengthen its position in the market. 3. Assessing a company through financial ratios. Greenwald places particular emphasis on assessing financial ratios when determining the value of a company. Strong financials. Companies with strong financials, such as stable earnings and abundant cash flows, are often ideal choices for value investors. Greenwald recommends that investors focus on companies with high free cash flow, which indicates the company has the ability to generate sustainable profits. Reasonable P/E and P/B ratios. Ratios such as P/E, price to earnings, and P/B, price to book ratios should be carefully analyzed to assess whether a company is overvalued. However, Greenwald emphasizes that financial ratios must be placed in the context of the industry and the company's long-term strategy. 4. Margin of safety. The concept of margin of safety is one of the important principles in value investing that Greenwald put forward. Investing with a margin of safety. According to Greenwald, investors should only buy stocks when their price is lower than the real value of the company by a large enough level to minimize risk. This difference is the margin of safety and helps protect investors from short-term fluctuations in the market. Minimizing risk. Having a large margin of safety helps investors minimize the possibility of loss and take advantage of long-term growth opportunities when the company's value is undervalued by the market. 5. Finding investment opportunities in inefficient markets. Greenwald stated that the stock market is not always efficient and sometimes real investment opportunities appear at times when the market does not properly value the company. Take advantage of market irrationality when the market overreacts to short-term news or events. Stocks can sell off irrationally, creating opportunities for value investors to buy stocks below their true value. Look for overlooked stocks. Greenwald advises investors to look for stocks that have been overlooked or forgotten by the market, as these can be promising long-term investment opportunities. 6. Invest for the long term with a patient mindset. One of the key lessons Greenwald shares is the importance of a long-term investing mindset. Invest patiently. Value investors need to be patient and have a long-term vision. Investing in companies with strong intrinsic value will yield returns over time, not through short-term trades. Not affected by market fluctuations, Greenwald encourages investors to not be distracted by short-term fluctuations in the stock market and instead focus on the long-term value of the company. 7. Diversify your investments intelligently. Greenwald also notes that investors should diversify their portfolios intelligently to reduce risk. Diversification is not just for fun. Diversification needs to be done strategically, meaning investing only in stocks that you understand and believe in their long-term value. Don't be too spread out, while diversification can reduce risk. Greenwald also warns against being too spread out, as this can reduce the chances of achieving high returns. Conclusion: Bruce Greenwald's value investing provides a comprehensive look at value investing, with principles from legendary investors like Benjamin Graham and Warren Buffett. By focusing on the true value of a company, sustainable competitive advantages, and investing with a margin of safety, Greenwald helps investors develop a patient, intelligent, long-term strategy. These lessons not only help protect capital but also create sustainable profits in the future.